Hey there, my investing curious friends. I'm Brian Sozzi, Yahoo Finance's executive editor. Thank you for joining us either on YouTube, Yahoo Finance, Spotify, iHeartMedia, Pandora, or Amazon Music. Lots of places for Opening Bid. If you're loving Opening Bid, hit us with those likes and fire off your questions and hot takes to me on X at Brian Sozzi and at Yahoo Finance. We are here to help and listen. Now let's make some money and, make you a better investor. Joining me today is Interactive Brokers Chief Strategist Steve Sosnick, or AKA the other Soz, right?
Good morning.
I will yield it to you.
No, that's okay, but we have to be specific about Brian and Steve. This is one of the few times where it gets a little dicey in terms of who's the Soz here.
We're really going to put you, we're actually going to see who earns the Soz last name here today, because we're going to put you through the ringer. But before we do, we got a lot of topics. How do you start your trading day, Steve? Because this is early. You know, not a lot of people get up at this time to talk about stocks, but clearly I follow you on Twitter, and you seem like a passionate dude.
For better or worse, I am. And, you know, I've got my routine. My morning routine basically is I basically first read what comes in. And I guess, you know, this is not a shameless plug. I actually do read the Yahoo Morning.
Hey, I mean, you know what? You earn the Soz.
When it comes in at 6 a.m., I do read it. I've read it. I read it this morning. This morning I read it on the subway, but on the way here. But it happens. For better or worse, I'm also a Bloomberg Terminal subscriber, so I read a lot
all right.
of
Well,
content,
okay. All right.
Which is really not all that germane to the average investor. But what basically consume what you can. There's a lot of information out there. Get it, read it. You know, the Deal Book newsletter from the New York Times is a very good source too. Basically, but if you scour the sites, if you scour, your homepage, the various free content that's available, to an investor, you could come in really well prepared for the day.
Do you check any specific stocks?
I check my watch list and just sort of see what's on there. I tend to look at more what's moving than a specific. Does it matter too much if, let's say, Microsoft is up a 0.25% before the open? Not really. So I really want to see if there's anything that's moving in a major way, because that'll point me to where the news is. All
right. Well, that is done and dusted. Good stuff there. Let's first topic for us is really reportedly President Biden looking at more tariffs or targeted tariffs on China. Now, what we do know is they may not be as draconian as former President Trump, who wants 100% tariffs on things coming in from Mexico, potential 60% tariffs on this, something on that, 10% stuff on China. It's all over the place.
Yeah.
What is the risk of what may be more targeted tariffs on China? Do investors need to care about this today?
I think we do, and because there's a couple of different reasons. If a tariff is a tax, and although there's been some rhetoric that it's a tax on the foreigner, no, it's really a tax on the American, because what it does is it's making imported goods less competitive, thus more expensive, and so that also allows domestic producers to either maintain or raise their prices. So it does filter back. In the case of the rumored tariffs that Biden is talking about, a lot of them are on at electric vehicles. Having just been to Mexico and seen how many BYDs are driving around
BYDs in Mexico?
Yep,
wow.
Lots of them. Basically, they're all over the place. Their taxis are almost all, they're moving a lot to BYD. And as a result, I'm guessing, having just made deals with the auto workers and stuff like that, this is sort of the back end of keeping promises. It's an election year. People are going to be there's going to be a lot of rhetorical argument. On the larger front, I was reading just this morning and last night, The Economist had a whole series about how globalization is going in reverse, and this is possibly another sign of it. And that's, there were a lot of benefits of globalization. We can debate the politics here and left and right, but from an economic point of view, globalization put a lid on inflation to a large extent. I think we were able to skirt a lot of inflation even with zero interest rates because of the positive effects of globalization that occurred let's say over the past, over the 20 years leading up to the, basically the first 20 years of this century. If that goes into reverse, that can have some negative consequences in terms of inflation, which is what seems to be problem number one now anyway.
You think this is the start of a potential China trade war with the U.S.?
It could be. I mean, it depends where they go and how deep they are.
I mean, you have to think China retaliates.
Of course. And so the question is how. I mean, so, in terms of, for example, let's say it's targeted specifically at electric cars, which is one of the things. I do believe China, to some extent, is subsidizing BYD. Who's retaliating against whom? At that point, are we retaliating against sort of a state-subsidized enterprise by putting tariffs on to reverse sort of the implicit subsidy. That's a level of political discourse that I'm not even capable of getting into because I don't know the nuances. But that's, if it gets into a little bit of a tit for tat, that becomes problematic. And there was a story today that China is looking to raise, call it about $140 billion worth of long bonds. And one of the reasons they said it is preemptively as a shield against the effect of potential tariffs. At this point, they're definitely thinking that this is a possibility.
Then what's the risk to stocks?
The risk to stocks,
which are trading at highs.
Of course, yeah, of course,
completely ignoring everything. Pretty much.
I'm sure you and I will get into that in a couple seconds. But the risk to stocks is anything that throws sand in the gears of the economy or sand in the gears of the consumer is problematic. For example, if this raises the cost of living, it's sort of a hidden inflationary element. It makes it harder for the Fed to say that prices are coming down, that inflation is under control. And this is where it becomes problematic. Because tariffs do eventually come out of the consumer.
Well, I think there was a good bit of research recently out of the Goldman Sachs team saying any new tariffs would, I think, decrease GDP by 1% and increase prices by 1%. I mean, that's a big hit.
No kidding. And I'm not going to pretend to debate what their economists have found. I'm just not prepared to do that. But intuitively, yeah, that makes sense. It's adding inefficiency to an economy that desperately needs efficiency. We can argue the politics of it, whether it's better or not. That's a debate maybe for different people at another time. But I don't disagree with Goldman's basic premise, even if I can't verify the numbers myself.
Then is it time for investors to pay more attention to the presidential election? Because I get President Biden reportedly coming out with what might be targeted tariffs on China. President Trump seems very aggressive. Both of them are targeting China, which is a key trading partner of ours. But oh yes, you still have multinational companies like a Starbucks, a Tesla inside this country doing business. How don't their multiples take a hit?
Right now, I think I don't know how they don't take a hit. But this is kind of the mystery of the stock market now anyway. Multiples. We've seen a lot of multiple expansion, and this gets into one of my themes that I've been working on is the question I've been asking is, does EPS really matter?
Does it?
Yes, but no. And this is the interesting problem, right? So, of course, nothing matters more to an investor than earnings per share and the associated measures, cash flow, revenues. As a former analyst, one of the one thing
I'm trying to ignore those days. I don't want to compute models anymore, Steve.
But
I appreciate what you're saying.
But the one thing is you can't fake cash flow.
That's true.
And
well,
so,
I mean, some companies could.
Some try, but ultimately, if you're not generating cash, you got problems.
Yes.
And so all those numbers are always very important. But the problem we have now is when you're in a situation where between 75 and 80% of the companies routinely beat their EPS estimates, investors are increasingly looking beyond EPS. And so it raises the question of think about how many companies have reported better than expected EPS and then got whacked anyway because they missed
Netflix. They said they were pulling back a number on their future earnings releases. I mean, that was a good quarter from Netflix.
Yeah, Meta. I mean, we can go down a list. Starbucks, I think, did this. We can go down the list of companies that had better than expected EPS.
Don't get me started on Starbucks.
Well,
we don't have enough time for that company.
Okay, so I'll leave that one alone. But then what happens is, so investors are looking past it. So, because in my mind, the question I think has become, have managements gotten better at managing their bottom lines, or have they gotten better at managing their analysts?
Look at all the stock buybacks. I think they've gotten really good at buying back, being very aggressive on stock buybacks, but also playing the street. I think they just have got the street figured out.
That was literally the next part of my comment was, have they gotten better at managing their bottom line, or have they gotten better at managing their analysts? And I think they have gotten better at managing their analyst perceptions. And so as a result, if everybody's above average, then you've rendered the average somewhat meaningless, and I think that's what we're seeing. Interestingly, I saw a statistic, and I wish I could cite the source. Basically, two statistics, conflicting articles. Basically, one that analysts are raising their EPS estimates this quarter, despite the fact that only about 15% of the companies are actually gave positive guidance, increased their guidance. Well, something's got to give, and I think maybe it's the analysts getting tired of just constantly missing the numbers. But if you're raising analyst estimates at the same time that the companies are not raising their guidance, something's got to give at some point.
There's let's just stay on EPS guidance. I wasn't going to go there, but I will. A lot of numbers in my head, and I saw a good chart from the team over at Evercore noting earnings per share for the 493 other companies in the S&P 500. Those earnings are supposed to accelerate this year and next year. By extension, the Magnificent Seven, Amazon, Apple, you name it, that earnings growth is expected to decelerate over the next 2 years. So then what's the better play?
Well, in theory, I'm a believer in trying not to chase the stuff that's been winning. There are values out there. I guess I'm inherently a value guy. And to me, one of my big tells right now is you're not going to go too wrong if you buy companies that pay a solid dividend, as long as that dividend is supported by cash flow. There, I keep coming back to
Thanks
cash
a
flow.
lot. You're giving me nightmares, Steve.
But what happens is if the company's borrowing to pay its dividend or borrowing to buy back its shares, all right, that ultimately isn't sustainable. If a company, though, and Apple being the poster child for this, and I have a feeling we were going to segue there anyway, Apple being the poster child for this company spins off so much cash, they don't know what to do with it anymore. And so they're returning it to shareholders. Yes, they raised their dividend. Yes, the dividend is kind of still only about 0.5%. It's pretty meager. But you're starting to see companies return more money to shareholders, and I think that's a good thing. And if a company pays a dividend, as volatility increases, it gives it a little ballast. And so I think you're not going to go too wrong if you're buying stocks that can afford to pay a decent dividend.
All right, hang with me there, Steve. If you're watching Opening Bid on streaming platforms, we're heading for a quick break. Everyone else, stay with us. We're still rocking our 24 minutes for Opening Bid as usual. Steve, you were making some really good points on stocks. And before we jump to a few more topics, do you think the Mag 7 trade is just done for this year?
Ask me that on May 23rd.
What's May 23rd?
May 22nd is when Nvidia releases its next earnings.
Interesting.
So ask me that then. And because, speaking of companies that beat, raised, and still went down anyway.
I upset myself. I did not remember that Nvidia's earnings was.
Yeah, we forget about it because it seems like earnings season is ending. I'm traveling that day, of course.
Oh no! Well, you got to cancel the travel. What are you doing? You can't go anywhere where Nvidia reports.
I'll log in. I'm not going far. I'm only going to Canada. That's okay.
Okay.
But you know, one of the questions we have is, for example, ARM. Speaking of companies that beat on the
big semiconductor play.
Yep. ARM, which you know, one of the classic AI plays. They actually do a lot of the chip design that for AI. I believe they actually do it for Nvidia as well. They beat their EPS because everybody beats their EPS. They actually raised their short-term guidance, but modestly lowered their long-term guidance, and the stock. Originally went down 6 to 8%. It ended up closing the day, I think, between 2 and 3%. But that's sort of the classic example. Have we outkicked the coverage? And we'll know this because last quarter, Nvidia went up about 16% after earnings. Quarter before that, even though they beat and raised, and this company has been.
Nvidia can't do any more. All these quarters have to be priced in.
So the prior quarter, the stock beat on every metric and went down 2.5%. So it does happen. So if Nvidia gives any signal that things are sort of not, that's going to break the cycle of beat, raise, which, to be fair, this company has been perhaps the best I've seen at this.
Is Nvidia still the most important stock in the stock market?
I believe it is. I believe it's the poster child right now.
Because of all the AI?
Because of all the AI. And to me, the other part that I think has to be addressed is during Meta's conference call, I called it, Zuckerberg said the quiet part out loud. Because he dared to say that, for all these billions they're spending on AI, it may take years for that investment to pay off. So, what does that mean for an Nvidia? At some point, you've invested the money in your AI development. You bought the chips. You've signed up, whether it's OpenAI or whomever is going to do this. And in Meta's case, they're doing it themselves. At some point, that has to pay off. It has to be a bottom line. It has to work on the bottom line. Think back to the internet days, where in '98 through 2000, we heard all about the promise of the internet. And to be fair, it was true, and actually then some. So
look what we're doing. We're recording something that goes on the internet and like goes to the streaming platform. None of this crap even existed.
none of it existed. It wasn't even dreamed of. And so let me stipulate that the internet was everything it was held out to be and then some. Problem is, if you bought all the internet stocks in those days, it took years for these investments to pay off. And by the way, the two of the big leaders on the internet didn't exist in 98 to 2000 because it was Meta, who we've discussed, and Google/Alphabet. That didn't exist either. So, I still think that the AI company for the century could be being developed in some 14-year-old kid's garage somewhere.
You're really giving me a lot of flashbacks today, Steve. Now I'm thinking about, not that I'm not, of course I'm listening to you, but I remember 1999 using Yahoo Finance to play the Yahoo Finance stock trading game. One of my stocks, I'll never forget this, I don't know why, was Global Crossing. Remember Global Crossing? I think it was GBLX. Wow, I can't believe I even remember that, but it was wild. But I mean, everything just exploded.
But it went from like 3 to 300 to 3 or something like that.
It was totally abnormal.
I don't think we've seen that ridiculous overvaluation again, because Nvidia and some of the other ones have been putting up the numbers. It's not just on hope. It's not just on eyeballs. I remember one of the great quotes from that year. I don't remember who said it. Was we were being the metric was eyeballs, which is great if I'm an optometrist.
That's how I was paid in my early career, Steve.
Exactly, by eyeballs.
We'll give you exposure on a Twitter account or somewhere. Yeah, and that's how you're going to get paid.
Yeah. So we moved beyond that. But the lesson I think to take away is, I'm going to, let's say that AI is as life-changing as it's planned to be, as it's assumed to be, and I'm not going to dispute it. I will say that AI as a concept has been worked on for decades. It's something I studied neural networks and stuff in college. So,
really?
Yep.
You never told me that.
Well,
what was that like?
Well, it was part of my I had two majors, finance and decision sciences, and decision sciences would now be called behavioral economics. But part of it was being able to make decisions. And among other things were, neural networks and the burgeoning, science behind AI.
I have to work that into the title for this podcast somehow. I don't know how I'm going to do it.
I don't know how.
Just give me a second.
Good luck with that. You're the journalist.
Well, thank you for deciding to come here, Steve. But I wanted to leave enough time for Apple. I know you've been writing about this on for Interactive Brokers and on your blog. Apple has not had a good year, but they came back out. When they reported earnings and announced, $110 billion stock buyback. That is huge. You still have the Warren Buffett backing. Is this stock just too cheap to ignore? A couple of folks I was talking to on the buy side recently suggest that their AI announcement in early June may be that trigger that just sends the stock through the moon into year end.
It's possible. Since November, I've been sort of arguing that Apple is not a growth stock, but actually the premier value stock. And I think that's a very important distinction. And that, to me, unfortunately, because the market distinguishes rich and cheap based in some ways upon your growth versus value.
Well, how do you define a growth stock?
One that grows.
Like revenue and earnings?
Yeah, which Apple doesn't. I'm sorry. Apple's revenue, Apple this quarter recorded yet again sequential year-over-year revenue decline.
And everybody ignores it. It's the strangest thing.
Exactly.
You don't even see it in the headlines. It's looking at you on the earnings release, sales and earnings down, but in your head you're thinking sales and earnings were up.
Our earnings managed to eke out a penny better than the prior.
And somehow that equates to year-over-year increase.
Yeah, and so what happens is, in my mind, consider me weird, old-fashioned. I prefer if growth stocks actually grow.
Growing, yes.
Yeah, that would be one of my criteria. Yes. Now, Apple is a phenomenal cash flow generating machine. I have an iPhone. I use iCloud and spend the money for that. They collect a fee off of my MLB app that I use.
You've
and all
never
these
sent
other
me anything. No, nothing, Steve.
Okay, but we'll work on that. But I use Apple Pay. So there's all these different ways that Apple collects money from me, and also to some extent, I carry around an AI assistant whenever I say, hey Siri, how do I do this? So it's there, but it's all there except the growth. And I read their announcement about buying back an insane amount of stock as basically their acknowledgement, we're a value stock now.
You know what the amazing thing is too? I want to dive into that point a little bit, but people think when they see a $110 billion buyback that all that stock is bought back in a single quarter.
Yeah.
First of all, that does not happen. And second of all, they're under no obligation to buy back all of that stock, and it may occur over a number of years.
And also, a lot of it is to just reduce the dilution that they have from issuing shares to employees, which, if the stock is relatively stagnant, they may have to up their stock compensation. So there's a whole bunch of moving parts. But the bottom line is they have more cash than they know what to do with right now, and they're doing something with it that's shareholder friendly. The question of whether it's rich or cheap is, which metric do you use? If you're measuring it as a growth stock, it's cheap. If you're measuring it as a value stock, it's not cheap. But I will argue it warrants a premium valuation as a value stock because it's such a fortress.
But it sounds like Apple is a nothing stock. And let me hang with me on this.
Yeah.
So it's not a growth stock because sales and earnings aren't growing. Maybe it's not a value stock because sales and earnings are still falling. It's just in this weird gray zone of matter, maybe.
And you can look at it as the best utility out there.
Wow.
To some extent, and that's damning with faint praise, but in some ways it is. I mean, I write them a check I don't write them a check physically, but they collect money from me.
Me too. I have extra storage. They swipe an extra $2 out of my account. I just get
all the
alert on my
time.
phone.
So
I don't know what it's getting used for.
Yeah, so you're, whatever, iCloud, who knows? But the problem is they collect money from me every month, just like my electric company, just like the cable company, just like all these companies. And so in many ways, it's the premier utility. And that's a good thing. That's a good thing when markets are volatile because, utilities are a defensive play, although actually they've been rallying now, I think, because of the demand for AI electricity.
Well, then what's the better play here? Is it Apple as a potential value stock, buying back a lot of stock, or is it Nvidia that's still growing a lot, but it may all be priced in? How does the trader think?
The trader thinks to be opportunistic. I think if I were investing, I think there's actually less risk right now in Apple, although I don't think your returns are going to be quite so high. I think there's much more risk in Nvidia. It's a pure risk reward situation. If Nvidia can continue their remarkable run of beat, raise, which again, I don't think I've ever seen one like this. And tell me if you have, but I can't think of a company that's ever done this like at such a meteoric pace and so routinely. If they can keep that up, great. If it turns out that we hit a sort of a lull in the cycle, the AI adoption cycle, whereas people have bought all these chips, people have subscribed to to Nvidia's AI, the sort of the software behind the semis. At some point, does that peter out, and are we pricing in so much growth? The one thing I will say in Nvidia's favor is, for a company with this kind of track record, it's actually not that expensive. It's not insanely priced, but if you look at its PEG ratio, the PE over growth, it's actually not so bad. I don't remember what it is offhand, but last I looked, it was like, oh wow, that's actually not terrible.
And of course, you can find that PEG ratio for Nvidia on the Yahoo Finance platform. Steve, in the 30 seconds that I have left, I always try to leave investors a little more inspired than the day before, or try to make them better than the podcast before. What's the best investing tip or advice anyone has ever given you?
Watch the cash flows. I know I keep saying this, but from a fundamental point of view, from a trading point of view, there's a whole bunch of them. But from a fundamental point of view, I've raised it before in this podcast, is you can't fake cash flow, and that is if you're looking at a company and they don't generate cash, ultimately you got a problem.
Thanks for always making time for us, Steve Sosnick, Interactive Brokers Chief Strategist. Good to see you, my friend. We'll talk to you soon.
Same, Brian.
Appreciate it. That's it for the latest opening bid on Yahoo Finance.